Hi, we are Ribbil Corporation. We will be presenting our final report for years 5 and 6. My name is Vincent.
My name is Trianis.
I'm Jeff.
Hi, I'm Stephanie.
Hi, I'm Lavinia.
So to start off, we will be talking about the mission and the vision. Ribbill's mission is to create a luxury shopping experience for our customers and to also provide high-quality products in a small niche market. Our vision is to expand our company into other markets and territories and to create products that our customers will like. We would also like to create brand loyalty with our customers and to keep our sales personnel happy. Here we have the industry sales. As you can see, starting in year 5, we had one of the lowest sales. Here is our company represented by the red line and the industry sales, or the industry average, represented by the gold. As you can see, we had a dramatic increase from year 5, quarter 2 to quarter 3, to the point where we actually exceeded or matched the industry average. And here's our market share for years 5 and 6. It didn't really change much. It's pretty much stayed at 13%. But even though we had the second lowest market share, that goes well with our strategy of high cost and low sales. And here we have the stock price. For all of year 5, our stock price was pretty stagnant. But in year 6, we really tried to concentrate on increasing our stock price. It's represented here by the red line. Here's the industry average. Even though we are lower than the industry average, we are really trying to increase our stock price, and it's been a big concentration of ours. And now we're going to have Stephanie to talk about the strategies.
Our pricing strategy was to increase our prices with the new model so that we can match our quality and feature. We projected that there would be a 20% increase with new models and a 10% decrease every quarter after. In year 5, we started out following what we had projected, and we kind of kept it constant until year 5, quarter 4. We projected that we would have a new model by then, which is why the price is so high. But since we were not able to obtain the new model, we continued to lower our prices. In year 6, which is when we got our new model, we still could not match what we originally had projected. But we actually changed our strategy to match the GDP, and we continued to raise prices by about 20 cents until quarter 4. In quarter 4, our projected was we wanted to have our next model by then, but we still could not obtain a newer model. So we just raised it by a little to stay competitive with the rest of our competitors. The advertisement strategy was to increase advertisement during the high seasons, which is quarter 2 and quarter 4. We wanted to raise it about 15%. In year 5, we started out higher than what we originally had projected, and we continually raised our prices because our funds allowed for it. In year 6, it was the same. There was a continual increase so that it could help raise our sales. And Lavinia will talk about the operating strategies now.
Okay, I'm going to talk about the operation strategy. About the sales on our salaries, we wanted to increase the sales, our strategy for our sales, because our salespeople was resigning and the GDP was rising. But we decided we was giving them lower in year 5 than the actual projected in everywhere but except year 5, quarter 4, we went higher in livestock because we had more people resigning in livestock than anywhere else. So as you see in year 6, we still continue, we raised it, but we didn't raise it as much. As you can see in America 1, we raised the salary more in America 1 than in the other Americas because they were, because the people in there was doing more sales in America 1, and we wanted to keep our salespeople there because the cost for losing our salespeople is training new people, and we didn't want to have to continue to do that. So we decided that to keep incentives for the incentives for people to sell was to raise commission. So as you see, we raised commission above projected, and it's no cost to us to raise commission. So commission continued to raise in all places higher than projected than in livestock, because livestock we raised the salary higher than the projected. And that you can see that in year 5. And so so we're going to go research and development. And research and development, as you can see, in quarter 3, we put a lot into research and development in anticipation we can get the new model before anyone else. And that was a miscalculation on our part. So because we tried to be the first with the new model. So we decreased it in next quarter. So because of the mistake in judgment, we decided, and we looked at the industry trends, we noticed that people who came with the new models gradually increased R&D. So we decided to gradually increase R&D from this point on. So in continuing into year 7 and beyond, we will gradually increase it by 20% each quarter. So in training, we was below in year 5 the actual, primarily because we were we had the new lines in livestock. And so we increased it in year 6 to better productivity and quality. So we will continue to increase training for the future. So now, Alice will do the production.
So now I'm going to talk about production strategy. So in our 2-year plan, we mentioned that in year 5, quarter 2, we are going to move our plant to night stock and completely shut down our home plant, which we did in our game. We're going to build 4 more lines, and we're going to end up operating in a total of 6 lines, which we did as well. And as far as the product position, the way we choose our quality and features is we look at the decision sheet and we try to find the niche market that has the least competitors, and we try to go after that market. But at the same time, we're still trying to stay with the high quality market. Okay, so here is our product position. Overall, we've been following our projected features and qualities for our models, but in the areas that you see gray, those are the areas that we made some changes due to the market analysis. Per unit production cost, one of the main reasons why we moved our plant overseas is to reduce the unit production cost, again due to the fact that we're trying to produce a high quality product, which will cause our unit production costs to be high, and we're trying to reduce expense. That's why we moved overseas. Overall, we have been, compared to our projected cost, we've been doing a lot better as the year goes by. But for year 5, quarter 2, that's when we made the big change. That's when we closed down our home plant and moved to night stock. and that's why we think that that's the reason why the unit production cost in that quarter is the highest compared to the other one. So in year 6, quarter 4, you can see that the percentage difference between our actual and projected number is 23.18%, which is very beneficial for our company due to the fact that it's a lot lesser. So here is our production output. So the projected production output, basically we base this number by our forecasting Excel worksheet. This is, for example, for where it says 312, that's the max we can produce according to our forecasting sheet with 6 lines and 40 hours. But in reality, due to training and the worker efficiency, the numbers are a little different. The reason why year 5, quarter 2 has the lowest number is because we only operate with 2 lines. And if you notice, for year 6, quarter 3 and 4, we have the word OT by it. This is when we experience a high increase in demand and we try to meet our demand. So next I'm going to turn it over to Jeff, and he's going to be talking about financial analysis.
Hi, I'm going to talk about Ribbit's financial performance for years 5 and 6. Here we have the Ribbit's predicted total unit sales and comparing it to our actual, and we can tally up the difference. And as we see in year 5, we sold more than we actually predicted to sell, and as well as year 6, we sold 13.3% more than what we predicted in our forecasting sales. Because of this was a big boost to our revenue. Here we have Ribbit's return on assets for years 5 and 6. For years 5, we did not meet our goal of a 1% increase due to a net loss for that annual year. But for year 6, we were able to exceed our 2% goal by having a 26.5% ROA. For ROE, we again failed to meet our expectations for year 5 due to, again, a net loss for that annual year. But for year 6, we were able to, once again, exceed that number dramatically of 2% with a 34.9% return on equity. For market shares, we exceeded in year 5 our goal of having a 13% market share, yet in year 6 we failed to meet our objectives of 15.5. For stock price, we decided to implement a plan starting in year 5, quarter 3, where we were going to buy back some of our stocks. For the last 6 quarters, we repurchased 500 shares of our stock, and because of this, our stock price has gone up dramatically. For year 5, we had an objective of $1 per share, but in actual results we got to 61 cents, so we failed to meet that objective. But in year 6, we had objectives of $1.50, but we crushed that by having $2.46 at the end of that. Because of that, we were able to offer some of the dividends to our investors and return them for investing in our company. Unit production cost was lower than we expected for both years 5 and 6, so this proves that moving our factory to NISTOC only helped us produce greater profit margins and greater net income for ourselves. It was a good strategy to move our plant over there. For net income, we expected a $3.6 million projection for year 5, but we failed to meet that due to some unexpected moves in research and development, where we decided to put some high investment in towards, which didn't exactly pay off for us, because we ended up with just over a $1 million loss for that year. But for year 6, we exceeded our goal of $40.2 million with just over $4.3 million worth of sales. For our profit margin, again in year 5 it was not a very good number, but in year 6 we had a dramatic increase to 21.8%. Our debt to equity decreased from 51.46% down to 31.63%, and this is due because of we paid back $2,200 with the $2,200,000 of our bonds back. And the quick ratios and current ratios currently show that we are a very solvent company and will be able to pay our bills in the future.